Hey, hi, this is Gautam. Welcome back. So, Niva Bupa, which is a standalone health insurance insurer in India, so it is going to hit the markets. It's going to IPO pretty soon, or probably it would have IPO'd already by the time I release this video. Okay. So, in this video series, I would analyze Niva Bupa using Warren Buffett's framework. Okay? The framework that is described in his shareholder letters. So, I will apply his method in analyzing Niva Bupa, and I'll also walk you through the outcomes of my DC evaluation. All right. And the purpose of my channel is purely education. Okay? It's not to influence your buy or sell recommendation. Please understand that. All right. Okay. And yeah, so essentially, so this would be a short video series. It will have four videos or four video segments, if you will. So in the first video segment, okay, we'll understand the business model of a non-life or a general insurer as to how a non-life or a general insurer, how they make money. Okay. And again, we'll use Warren Buffett's method to understand the business model of these insurers. So this will be video segment one. Okay. And then video segment two would be, we'll analyze Niva Bupa in video segment two, and we'll compare it with its peers like Star Health and Care Health. All right. So that would be video segment two. In video segment three, okay, we would estimate the market size of health insurance industry in India, and specifically within health insurance, we'll estimate the market size of retail and group health segments, which are the two segments in which Niva Bupa is predominantly present in. And of course, we'll understand what is the retail and what is group later. All right. Okay. So this will be video segment three, and in video segment four, okay, I'll walk you through the outcomes of my thesis evaluation. All right. So if you're someone who's really not interested uh, in sitting down in understanding the business model, or in listening to the analysis of this company, and you are just here to uh, uh, see what is the valuation of this, what is the fair valuation of this company, then you can just perhaps go straight to the fourth video. You can skip the first three videos. You can go straight to the fourth video towards the end, where I conclude my value, where I walk you through the outcomes of my valuation. Okay. But again, at the risk of repeating myself, I am not a SEBI registered advisor. This is the purpose of this channel is just purely education. All right. Okay. So, and before we get started with video segment one, okay, I wanted to tell you that I've already made two detailed videos. Okay. First, one detailed video is as to how do you analyze a general or a non-life insurer using Warren Buffett's method. I've already made a detailed video on that. Okay. All right. So I'll probably link it in the description. And another video I've made on on general insurance, is on the health insurance industry. Okay. And so I would strongly recommend that at least you watch the health insurance industry video. Okay. All right. It's a 30-minute or so video. Okay. And you can watch it at 1.25 or 1.5x speed. All right. And because see, you cannot really understand a business without understanding the industry in which that business operates in. ठीक है, तो देख लो वाला वीडियो इंडस्ट्री वाला. It would be it would be beneficial. मैं again I'll put the link in the description. All right. Okay. So anyways, without further ado, let me start with video segment one, which is let's understand the business model of a non-life or a general insurer. All right. Okay. So let me start with that. All right. Thank you. So let's see, general insurance business. All right. It makes money largely the same way as a traditional bank. It sounds weird, right? But that's true. Okay. See, bank gives us an interest on our deposits, which the bank uses to give out loans to customers at a higher interest rate. Okay. The bank makes money on the interest rate differential. Okay. Now, a well-run general insurer, on the other hand, is able to raise money many a times at a lower interest rate than a bank, at times even at zero interest rate, or at times at negative interest rate. And then, much like a bank, the insurer then reinvests or invests that money at a higher interest rate and earns on the differential interest rate. Okay. Now, you must be wondering, if this is the case, then where do the insurance premiums and the claims go? All right. So let me explain. Okay. Let me explain the business model using a very simple example. Okay. See, remember, premiums are received upfront, and premiums are received upfront pehle hi, and then claim payments, they come they come at a later point in time. Okay. All right. So let's take the example of ICICI Lombard. So let's say ICICI Lombard collects 115 rupees worth of premium in a given year from its customers. Let's call this gross written premium. Gross written premium. This is the premium that they collect from the customers in one particular year. Okay, all right. Now, from this 115 rupees, it pays out rupees 5 as reinsurance to, let's say, General Insurance Corporation of India. Okay. See, in India, it's mandated, the regulator has mandated that all the insurance companies, all the general insurance companies, they pay out a small reinsurance premium to a reinsurer like GIC, okay, to cover extreme risky tail events if they are to uh, occur. All right. Okay. So every insurance segment in India, health insurance, motor insurance, marine insurance, fire insurance, they have a different prescribed reinsurance premium limit set by the regulator. All right. Most of the insurance companies in India, they pay more than the prescribed limit set by the regulator. All right. That's just some side information. All right. So any which ways, they pay out 5 rupees from this 115 to GIC. So what they're left with is 110, right? Let's call this net written premium. All right. Okay. Now, from this net written premium, all right, what they do is they're left with 110, right? So part of the remaining 110 rupees worth of premiums every year are set aside to cover future claim payments. I'll repeat. Okay. Let's say from this 110, they set aside rupees 10. This is set aside or reserved, okay, to cover future claim payments. All right. Okay. So what they're left with is 100. Let's call this net earned premium. Earned. Itna bacha. All right. Okay. All right. And by the way, okay, this 10 rupees that was set aside or reserved for future claim payments, okay, this is added to something which is called float. Warren Buffett, he calls this float. Okay? Because in his, how he describes this float is, this is the money, okay, that the insurers they have, but they don't own the money. They set aside to cover future claim payments. Okay. But on this float, on this rupees 10, okay, they invest it and they earn an interest on this money. ये पैसा उनका है नहीं. They'll have to pay it out eventually in the form of future claim payments to cover future claim payments, but they can enjoy this 10 rupees for the time being because they'll invest it and earn an interest on this 10 rupees. Buffett calls it float, this 10 rupees. Okay. So any which ways, now they are left with net earned premium of rupees 100. Okay. And this concept of floats is important. I'll revisit it. Okay. So now let's say this net earned premium of rupees 100. Okay. 100, this goes towards 32 rupees of expenses in the form of, commission to agents, insurance, particularly retail insurance is a push product. So you have to employ insurance agents. So in the form of agents to commissions and, all the other expenses that you are underwriting, policy underwriting, all of those expenses, they would fall here. So from this rupees 100, they pay 32 in expenses, okay, and 70 rupees in claim payments for that year. Usi saal ke claim payments. This rupees 10 is set aside for future claim payments that may come in the future. But this rupees 70 is paid for any payments coming in that year itself. All right. So now they've paid 70 and 32 in the form of claim and expenses. So they end up making a loss. Okay. This underwriting profit or loss, the profit is -2, right? 70 plus 32, 102, right? But they only had 100. So they make a underwriting loss of rupees 2 and underwriting profit of -2. All right. Okay. So this insurer makes a rupee 2 loss on the net premium in that year. This is called underwriting loss, as I said. Put simply, this underwriting loss of rupees 2 is akin to the cost of raising money or the cost of acquiring that float, as Buffett calls it. I'll repeat. Put simply, this underwriting loss of rupees 2 is akin to the cost of raising money or the cost of float, as Buffett calls it. Okay, like previously stated, insurer earns interest on the float that it acquired. Okay, please keep that in mind. Okay, so let's say the accumulated float, I'm using the word accumulated. Let's say the accumulated float, because accumulated as in 10 rupees you accumulated this year. Let's say 15 rupees you may have accumulated in the prior year. So you keep on accumulating float. So the accumulated float over time, including the rupees 10, which was set aside this year, okay, totals up to 100 rupees this year. And this includes the 10 rupees from this year as well. So let's say the accumulated float, okay, is rupees 100. So the cost of float, is rupee 2, which is this. This is the cost that they had to pay, right? Underwriting loss is rupees 2 divided by 100. So the cost of acquiring that float this year is 2%. All right. That is the cost of, so this cost of float, think of this as the cost that they paid, okay, to get this money. All right. See, a bank pays interest on the deposits, right? So that is the cost of fund for the bank. Deposit, again, the deposits that the bank have, that's the money that they have, but they don't own. Okay. The interest rate that they paid us on our deposits, it's the cost of fund for the bank. ऐसे समझो. Okay. So again, this is the cost of float, or kind of the cost of mota deposits for the insurer. Okay. So they had to pay 2 rupees on rupee 100. They had to pay rupees 2 to acquire this float of rupees 100. So the cost of float is 2%. All right. So now this is good because for this insurer in this example, because the cost of float of 2%, the cost of float of 2% this year is less than the market rate of raising money. Let's say the market rate of raising money is 4%. Agar they would have gone, this company would have gone to a bank to raise this 100 rupees. Maybe the bank would have, let's say, charged them 4%. Okay, but on their own, they have been able to raise this rupees 100 in just 2%, at just 2% interest rate. So the cost of float for this insurer in this hypothetical example, the cost of raising funds is lower than the market rate of money. All right. Okay. Just like a bank, an insurer makes money on the differential between the investment returns and the cost of float. So let's say now this insurer, of course, would invest this 100 rupees. Okay. Let's say they make 8%. Let's say I'm talking about return on floats. Let's say they make 8% on this rupees 100. Okay. All right. But the cost of float is 2%. So the return that they make, the return on float is 6%. All right. Now, what Warren Buffett says is, if the cost of float, over time, okay, is greater than the market rate of money, then in the language of Warren Buffett, the insurer is worth lemons. Okay, I'll repeat. If the cost of float over time, 2%, is greater than the market rate of money, then in the language of Warren Buffett, the insurer is worth lemons. All right. Okay. But in this case, we saw that the cost of float is lower than the market rate of money. So which is good. All right. And you would see that only a handful of Indian insurers like Star Health and Care Health, they have a negative cost of float. What it means is that let's say their expenses, let me use a different pen to illustrate the example because it's important. What it means is, let's say insurers like Star Health or Care Health, okay? Let's say their expenses is only, let's say, I'm making it up, 28. Claim payment, let's say it's 70. Okay. So total payout is 98. Okay. So they are making a profit of rupees 2. They are making an underwriting profit of rupees 2 instead of a loss. Okay. So the cost of float for them is negative. That means they are being paid. So the cost of float for them is -2 by 100. So that means they are being paid 2% उनको मिल रहा है भाई पैसे तो 100 रुपए तुम उठाओ और 2% और ले लो for raising that money, right? So any which ways, even if you're making underwriting loss, as long as the loss is small, it's fine because still you make money on the still you make money on the 100 rupees of float. Okay, and you make a overall return, sizable return. All right. All right. Okay. All right. Now coming back to this example, okay, let's say the claims ratio. What is claims ratio, by the way? The claims ratio is the the claim payments that they make on uh, the premiums that they collect. All right. So the claims that they paid out in this example was 70 rupees. And what is the premium that they collected? They collected 100 rupees of net earned premium. So the claims ratio is 70%. That is 70% of the net earned premium are being paid out in the form of claim payments. That's what claims ratio means. Okay? And what is expense ratio? So we saw that they, in this example, that they incurred 32 rupees of expense. Okay? So should it be 32 divided by 100? In this case, when you're calculating expense ratio, it's calculated on NWP, net written premium, which is 110. Okay. So the expense ratio is 29.1%. 29.1%. All right. So again, expense ratio is the portion of the net written premiums that are paid out in the form of expenses. That is called expense ratio. All right. Okay. Now, combined ratio. See, this is important because otherwise you would not really understand health insurers. You would not understand the business of Niva, Bupa, or any insurer for that matter. So this is important. So combined ratio is the sum of claims ratio plus expense ratio. So in this case, it is 70 plus 29.1. It is 99.1. Claims ratio 99.1. Just be with me for now. I'll explain what this combined ratio means. Okay. There's another useful metric which is called underwriting balance ratio. Underwriting balance ratio is net earned premium minus claims minus expenses. All of this divided by NEP. Okay. So mota what it says is, are you making an underwriting profit or you're making an underwriting loss? So in this case, okay, it is 100 May. You paid out claims of 70. You paid out expenses of 32. Okay. Your NEP is 100. Okay. All right. So your underwriting balance ratio is minus 2%. That is, you made a underwriting loss. That's what this ratio tells us, underwriting balance ratio. It tells you whether you're making underwriting profit or underwriting loss. In this case, you're making an small underwriting loss. And as I said, if you're making small underwriting losses, that's fine, so long as the cost of float is lower than the market rate of money. All right. So anyways, the reason what I wanted to focus on is, okay, see, although the insurer made a small underwriting loss, okay, it still has a combined ratio less than 100. Okay, it still has a combined ratio. Less than 100%. Okay, typically you would see combined ratio is a good proxy to gauge the cost of float for an insurer. Okay, a combined ratio which is less than 100 typically signifies that the cost of attaining that float is negative. That is, the insurer is being paid to acquire float. But as you saw, in this case, that may not always be the case. Okay, all right, because even if a combined ratio is below 100, the insurer may not be turning a underwriting profit. So underwriting balance ratio is slightly a better metric, is a slightly better measure in finding out whether the insurer made an underwriting profit or underwriting loss. All right. Okay. This is important because in the context of Niva Bupa specifically. All right. Okay. So hope this gave you a good understanding as to how a general insurer, it makes money. Okay. And how it works. The business model is very akin to a traditional bank. All right. And also hope you understood some of the terms which are used in this industry. All right. Okay. So this was segment 1 of the video.